All right, perfect. I think we are recording. So as I mentioned, Kacie Swartz is here to lead us through a discussion on ESG investing and what that means. This has been a topic that a lot of people have asked about. So I know a lot of people are already here and a lot of people are coming in. As I mentioned just a couple minutes ago, and now for the recording, nothing in this meeting is intended to be individualized investing advice. Both Kacie and myself are investing professionals. But we are here in an educational capacity to answer questions, to give our input, to share with you what we know about the topic. But take what we share with you. Always do your own due diligence when you're making your own investing decisions. And so without further ado, I'm going to turn it over to Kacie Swartz, Certified Financial Planner. Kacie, take it away.
Hey, everybody. Thank you, Sarah. Yes, I have been a member of the Austin Women's Investing Group for about 8 years since I moved here in 2013. And I have always loved being able to chat with everybody in the live sessions. And so this is my first time on the video. So please, everyone, thank you for your, I don't know what the right words are, but thank you for your patience as we all make this work. Appreciate that. And Sarah's right. So I kind of took a year off there because I had a baby in February of last year, and then we all hit pandemic, and weekends had no meaning. So Saturdays were still kind of tough, but hopefully everything's kind of getting back to normal again. So thank you all for joining us. I am so excited to be talking to you about sustainable investing. And as Sarah said, I would love to just jump right into that, because what is sustainable investing? It is too much to explain in one session. It's sometimes called ESG investing. It's sometimes called socially responsible investing or mission-driven investing. It really is whatever you want it to be, because it's just taking your dollars and pointing them in the direction of your values, regardless of what that is. And so I thought that the most wonderful quote I found was the concept of shunning profit that comes at the expense of our neighbors. I really loved that quote. I found it in some of my research for today. And the history of this type of investing goes back to pretty much every religious community, as well as more secular versions that have come across in the last 100 years or so, as investing has become more available to individuals, to regular people like us. And so during the 60s, during the civil rights movement, you saw a lot of community development financial institutions, which are essentially banking and financial institutions that were designed to help communities that were underserved or were not previously able to access financial assistance. And so that's one of the big things that came out of the civil rights movement. And then later in the 60s and 70s, you see Ralph Nader and some of the consumer rights things that he was fighting for started to really become more accepted, or more expected, I think might be a better word. And in 1970, he actually got 2 socially based resolutions to be voted on during the General Motors annual meeting. They both failed, but it was the first time that had happened. So that was kind of like a big moment when you look at the history of socially responsible investing and just interaction with commerce, I guess is the right way to put it. By the 80s, you started to see socially responsible funds really come together. So if you think back to just your history of mutual funds or exchange traded funds in general, they've only been around less than 100 years in the first place, and they weren't widely available until the 70s. So socially responsible kicked in pretty quick after the whole Vanguard launch in the 70s. And a couple of the names early on there were things like Parnassus, and Calvert, who started their socially responsible funds in the early 80s. The biggest history element of that is that they quickly gathered assets from things like church pensions and state pensions. And a more successful story than the Ralph Nader story is how those groups, universities, churches, pensions, along those lines, they all advocated to their money managers that they did not want to support companies, they did not want to invest in companies that supported apartheid in South Africa. And that was part of the movement that kind of cut the legs out from under apartheid, is that there was less commercial availability for the people who were continuing to run the system. And it's not a direct one-to-one, of course, but it was part of the culture shift that led to the end of apartheid, which of course didn't even end officially until 1994, but people were working on it. So that was really cool. And that's kind of the short version of the history. Does anybody have questions before we kind of keep moving into the next phases here?
Hey, Kacie, I have a quick question. Are you looking at your slides?
Yes.
We're not able to see your slides quite yet.
Do you think I should hit share screen?
I think.
Do you guys think that would help? Well, luckily you have only missed this one exquisite screen that I made. And I do think that it's worth sharing because that's a lot of arts and crafts for Kacie. So thank you for pointing that out, Gwen. Anything else?
That was really interesting.
Thank you very much. So I'd like to kind of talk a little bit more about what those socially responsible funds started out doing. The early ones, like the Calvert and the Parnassus that we're talking about, they started out by just filtering out. So as you can imagine, if you have the whole broad universe of companies to invest in, it's easiest to say, well, what do I not want? And what they said was they did not want alcohol, tobacco, firearms, nuclear weapons, and gambling. Okay, nuclear weapons definitely, the rest of those certainly. And so those were easier to filter out. So that's kind of where you saw the socially responsible funds starting from in the 80s, okay? The growth of the industry has been heavily pushed by women. As of 2020, this RBC study that they just did, nearly half of American women are primary breadwinners in their household, which has gone up by 400% since the 60s. The number of women who would qualify as wealthy, when you just look at like the hierarchies of wealth in this country, has growing so much faster than wealthy men, as you might imagine, because we have more room to catch up, that it's growing twice as fast by women who are qualified as baby boomers than men. And by 2030, women are projected to, either by being primary breadwinner or solo household, to be in charge of 2/3 of the wealth in this country. Women are also the primary purchasers of ESG funds and or socially responsible funds. The names are interchangeable. The thing that historically these funds have, just the fund universe in general has been measuring, is return performance. And there is enough background now to really have the numbers to say, you're not giving up anything if you invest in ESG portfolios. As of last year, There was $17.1 trillion invested in funds that have some sort of ESG title. It's up 42% from 2018, and it's 1/3 of the whole managed asset universe. 1/3 is now called ESG, right? Okay, so what even is ESG? It stands for a category of investments. So socially responsible is kind of like the ideal, but it's really broad, really vague. ESG adds some criteria by which these investments can be sorted. Sorted is a good word. So there's the environmental sleeve. So you're looking at climate change, you're looking at natural resources, you're trying to cut down on pollution and waste, everything along those lines. There's the social element. You want to see how labor relations are, what do they do with human capital, what's the liability for their products, do their products hurt people / help people, and what's the sourcing of the different components of the products that they're building, if they are manufacturing, for example. And then governance, the G, stands for the diversity of the boards, the gender equity, the pay to the executives, compensation in general, the ethics of the business, how are they cooperating with other businesses. All of these different categories have been defined because they can then be assigned ratings, and they can then be used to create scale for the different companies that are trying to be labeled ESG. Because as you might imagine, this is a growing category of the investment world. They all want in because they all want the dollars to flow to them. Traditional pooled investments like mutual funds and ETFs saw not as many dollars over the last couple of years. This category of investments is seeing huge growth. So we're going to get into kind of what that can mean for a caveat later, but keep that in the back of your mind that every company has reason to want to be labeled as ESG right now. Okay. And how do we do that measurement? Well, as of 1990, we now have the Domini Social Index. Amy Domini was a stockbroker in the 80s, and in the 90s, after her social index took off, she founded her own RIA firm, a registered investment advisor that treats all clients with a fiduciary level of duty. But back in the 80s, that really wasn't as popular. So she started out as a regular broker, but all of her female clients wanted socially responsible funds. And so by 1990, she had enough background, enough research that she was able to put together an index. And that index is what became the kind of guiding index for socially responsible investing. It is 400 companies compared to 500 in the S&P 500, but it was bought over time by a couple different groups. It is now being provided to the public by the ratings group MSCI. So you might have seen some other investments. The more common ones are the MSCI foreign indexes. They also run what is now known as the KLD 400. So when you're looking at ESG investments that are being benchmarked to an index, they will frequently be benchmarked to this particular index. Amy's only 70, guys. So this type of measurement has not been around a really long time. But since 2006, when we first started having record keeping, the performance of the KLD 400 has outperformed the regular overall US market by over 4%. And that's going to include 2008. See 2008? It's going to include 2020. And I think that this kind of time frame is long enough to say that this is a real outperformance. In 2020 specifically, the equity side of the fence The sustainable investments outperformed by, again, over 4%. Bonds outperformed by over 0.88. Okay, still good. And part of it is because of the dollars that are flowing into this category, but also it's because good corporate performance is something that everybody wants to invest in. Like, what's the downside, right? I think that this is something that is not a trend. It is not a flash in the pan. It is the future. So when we think about the old arguments that you're going to have to give up return to invest with your conscience, that's where we say it doesn't lag. So why not, right? So before I get into my next slide, which is, okay, great, I love it. How do I pick these funds? Does anybody else have questions? Are you guys just that convinced?
It doesn't look like we have any questions come in so far, but oh, Caitlin. Caitlin has her hand raised.
Caitlin, you're muted.
I know.
There you are.
You have.
Oh, okay.
It said the host has to unmute me. So Kacie, let me make sure I'm understanding this. So it's not, there's some sort of snowball effect here that women as a class more generally say we want to not only not invest in companies we don't believe in what they're doing, we want to invest in companies that we do believe in. So those companies get more capital because we're investing in them. And so they have a chance to do better, make more money, and then they become more appealing to regular investors who might not care one way or the other. Am I understanding that right?
Yes, there are two parallel paths there, but you are exactly right. There's the path of just general dollars flowing into this category, which then allows those companies to be more innovative, to put those dollars into R&D. Literally hours before today's presentation, I read another article in the Wall Street Journal about how green energy is so popular and all of these dollars are flowing into green energy, and it's letting these companies focus on things like creating rechargeable batteries that the original components are not quite as rare, and so like better for the environment in that way. And so you're absolutely right that's that momentum, that's that snowball. The second element of the female component is that as an intuitive, empathetic person, a lot of women, when we are investing, we care more about the impact of our dollars. And so in those early days, when it was the general belief that socially responsible investing was going to have a lagging performance, still the people that were putting those dollars into those socially responsible funds were by and large female. And those women who were female in the 80s, they're still the ones that are investing. And now they have these big, robust 401ks that maybe they're now baby boomers and they're retiring. And so they now have access to those accounts and they're saying, now what do I do with this? Where do I put it? And they want those dollars to continue to do what they always have cared about, which is to either protect the environment or to try and make social change, or they want to change capitalism in general with gender equity and more diverse boards, all of these different components.
Okay, and thank you. That is so helpful. And I also just want to understand, and maybe you'll go into it, who judges, like the criteria that's set for a company to qualify. It's coming. I'll shut up now. Okay, thank you.
No, Caitlin, thank you so much for segueing with that. That's the next slide.
Great.
Yes, genius. I love it. Okay, so do you guys want me to just jump right into that then? If there's any other questions?
There was going to be another question, but it looks like Betsy's question is also this slide, so we can keep going.
Okay, great. Okay, so How do we know if a fund is really ESG? And like I said earlier, the dollars, they are just flowing into this category. So as you can imagine, there is a lot of motive for people to put on an ESG overlay that may or may not be accurate, right? It can be tough because, again, it's not standardized. It's still kind of a Wild West environment. But MSCI, the group who is now running the KLD 400 index, they have 3 different types of screening criteria that they are using to measure individual companies, and that is giving scores. Morningstar also has sustainability scores, and so those are the companies that are doing the research to say, if you're holding yourself out as an environmentally friendly company, where's the proof? So what are you doing to actually qualify for this, okay? When it comes to ways to invest in these companies that are supposed to be doing good, you could buy individual stocks. I'm not going to get into that part because you know how to research individual companies, and I think that that's more personal. What I want to help you with is studying the mutual funds and the exchange traded funds that are out there, because they are a lot easier to buy, right? They're a lot more available. When you are looking at the mutual fund or exchange traded fund universe, there are currently 836 choices. So that's a little bit tough. And when you look at the individual holdings inside some of these ETFs, you're like, okay, none of this looks like, you know, Hearts and Puppies Incorporated. What is different about this? Well, again, the KLD 400, first of all, is going to continue to screen out nuclear power, tobacco, alcohol, gambling, military weapons. It now also includes civilian firearms, GMOs, and adult entertainment. Strangely enough, they had to set a 5% limit for the adult entertainment one, because things like Google, you know, like who knows who defines how you provide adult entertainment these days. And Walt Disney owns everything. So you really have to set certain parameters on how much of these things to screen out. When they are screening in, they are screening for those 3 different categories I was talking about. Number 1, risks and opportunities. They are providing ratings on that for the just general ESG ability to find opportunities to have, like, let's say, less pollution, or the risks that an ESG company might have, like if they are a palm oil producer or something like that, right? There's controversies. There's the negative impact of the company. That's the second criteria. They're going to get a scale on that one as well. And then the last one is business involvement, which is like unsavory practices or trade with countries that are generally sanctioned. Things like diamond mines in the Sudan. That's probably going to get you a bad score, right? And so those are some of the different criteria. Well, it leads to some moral gray area, because then you get companies like Amazon, okay? This is an example of how environmental, social, and governance might be working against each other. From an environmental standpoint, Amazon's kind of in the middle. Like it's pretty much the way most big giganto companies are. Social, not great. They got a real bad track record on that one. Lots of bad corporate behavior, lots of labor management issues. We all saw those stories about, you know, empty bottles, horrible, bad things. Governance, though, they're pretty good with their data security. So Amazon, you know, you have to take all of these different types and they squish them together and give them a composite ESG score. So this takes me back to voting on what values, what matters to you, right? If social is the biggest component for you, then you're not going to want to hold Amazon. And you're going to want to find investment funds that screen it out. So the regular index, you're not going to want that. You're going to want to go up a level to companies, or not companies, but funds that are doing a little bit more active investing, which in this case doesn't necessarily mean outperformance. It means additional screening. Okay, so like when we've talked in the past, or when Sarah has talked about active versus passive, it generally is indicating a philosophy of how a manager can create return. In this case, it not only means return, but it also means additional screening or additional due diligence into the companies that the fund is holding. Because if you just have the standard index, you might have a company that doesn't fit the particular values of what you're trying to achieve. Okay. Another example is right here. Which is more sustainable? Does anybody have a vote for Shell? Like, just raise your hand if you think Shell has a higher ESG score than Tesla. Of course not, right? Who would think that? What about Tesla? Who thinks Tesla has a higher ESG score? Right, exactly. Yes, you would think that it does. Well, it's a trick question. They have the same score. And the reason they have the same score is because they have pros and cons. Tesla has big, heavy cars, and those big, heavy cars are often powered by electricity that comes from plants that burn coal, right? They have terrible labor relations, and Elon Musk is a whole deal onto himself. Shell claims that they're going to be net carbon zero by 2050, and they are putting money into green renewable energy, and they have a gender balanced board. So although they are taking fossil fuels out of the earth, they still have the same score as somebody like Tesla. So it's a little bit confusing, and it can be really difficult. Does anybody have questions about this part? Okay. Because I'm going to get a little deeper into this. So the next part is about greenwashing.
Wait, hold on,
Has
Kacie.
anybody heard of...
Hey, Kacie, hold on one second. I saw Caitlin waving her hand. Caitlin, you have another question? Caitlin's back.
Oh, I can unmute. Sorry. I just have a question for scale. Because when I was trying to do the Shell Tesla, I thought, well, clearly Tesla will have a better rating because, you know, that's what their marketing tells us. But if Shell is all over the world, I worked in Africa, like they are everywhere. So maybe them getting better by 5% has a bigger impact globally than Tesla being better by 40% or something like that. Is that included in this, the scale?
It absolutely is, because it's a cap-weighted index in the first place. Capitalization of the company being how many dollars are in that particular company, how many shareholders there are, and how much money people have in that company. So you're exactly right. The scale of Shell is an impact. And again, back to that article I just read this morning, it's also part of a larger movement where it's just writing on the wall to think that these companies think that they can continue to mine fossil fuels for an undetermined future. Like, eventually they know they're going to run out. So yes, they are putting money into things that make them more money, things like solar and wind power. So of course Shell is moving forward with these alternate energies. And if they are getting asset flows because of it, or if they are getting government rebates because of it, or whatever they're getting, that's all just good business practice. And that takes us back to the more pragmatic element that good corporate governance is also kind of a staple of a company with a higher ESG score.
And when you say ESG score, I stepped away from my computer briefly. Did I miss the name of this index you're talking about?
Yes, so the index is called the KLD 400, and it's run by MSCI. And at the end, I'm going to have some resources where you guys can research these different types of scores in the different funds themselves. So that'll come up. I've got a couple email URLs for you guys as well. So we're going to get back to that. But yes, the short version is that one of the companies that runs the indexes is assigning scores to every single company that wants to be included. And so they are doing it on these different criteria for both environmental, social, and governance scores. Okay, so like we say, everybody wants in on this game, right? How do you know that they're doing the right thing? Well, one of the biggest problems now, I mean, it's not like it's rocket science. Again, it's called greenwashing. It's companies putting on a pretend of marketing or whatever they can do to try and get included into this universe that's gathering assets. And it can be a problem because these companies may not actually be doing the right things, or they may be doing like a shallow layer of the right things and then still destroying the earth with their other hand. That's definitely possible. But as has been pointed out, like every little bit helps. So the success of well-intentioned investors in, as they say, facilitating the flow of capital towards these good causes, that is still worth it. And this asset flow and the amount of dollars that is coming into this category over the last few years, because the scale is just bananas on how much it's been ramping up. Like that 42% increase since 2018, that's not normal, right? And so it's leading to more attention being paid to the issues of standardization. There is a new SEC climate and ESG task force as of 2020. They are covering climate policy. They are creating more framework for reporting from these companies so that they can create a more standardized way to measure the impact of the individual companies that are saying they are ESG focused. And as that continues, I mean, it's anything that's going to be kind of a messy process, but as it continues, we're going to see it become a little more transparent is a good word for it. And again, every movement that we have, I think, is helpful towards the ultimate goal of raising the discourse completely. One of the recent examples is the May 2021 shareholders meeting. Everybody knows Warren Buffett, this guy on the left. You may not, by visual, recognize the guy on the right. He is Larry Fink. He is the CEO of BlackRock. So during the Berkshire Hathaway shareholder meeting, BlackRock, one of the largest investors in Berkshire Hathaway, was trying to hold Berkshire Hathaway and Warren Buffett specifically more to task to increase their disclosure of their business practices, specifically for climate, but also just more transparency in general. And essentially the short version is, I mean, it's a little bit like Gossip Girl, but basically Warren Buffett said, no, I don't want to. If you don't want it, then don't buy it. Screw you. And Larry Fink kind of says, okay, we are the largest asset manager in the world, so okay. And that's kind of where it stands at the moment. And that is an example of how these things are going to go as the dollars continue to like flow where people care. So if people continue to say, well, Berkshire Hathaway is like a ballast in your portfolio and it should always outperform and it doesn't really matter what they buy because I'll do whatever Warren Buffett says, okay, well then the dollars will flow that way. And if instead they say, why don't you want to show me? Why don't you want to be transparent? That seems iffy. Then the dollars will flow away. Like that's supply and demand. That's the whole point. So both of these men have a good point. And as the individual investor, then we can kind of choose for ourselves. And lastly, Larry Fink is not like completely doing this out of the goodness of his own heart. BlackRock gathered $171 billion over the last year. So his whole climate change focus is also like fueled by money, right? And again, that's not necessarily a bad thing, because anything that draws attention to these elements moves the needle, and it creates more transparency, and it creates more standardized criteria for comparing these different companies. What do you guys think about that part?
So Caitlin asked if you know an example of something that Fink was trying to get Buffett to tell him.
Gosh, I don't. No. I think we could go back to the minutes of that shareholders meeting and find it, and it was all over the Wall Street Journal. It was seriously like reading a tabloid because they were so excited at the Wall Street Journal about it. But I don't have specifics at the moment. I know that they are trying to get more women in senior leadership. Like, this is like a whole letter that BlackRock put out last year. Like their shareholder letter last year was all of these things that they're going to do to make the world better. And it was more women in senior leadership, more transparency on climate change. So I'm assuming it's something about like pollution or waste, something along those lines. Okay, well, if nobody has questions about greenwashing, which the short version is do your own research, then we're going to move into my favorite part, which is, yes? Gwen, do you know who that was?
I am not sure. Did someone have a question and unmute themselves? You're welcome to unmute now.
Can you hear me?
Mm-hmm.
Yes, but we can't. Can you let us know your name? It looks like your name is iPhone to us.
iPhone, I can't hear you anymore.
Still.
There we go.
Oh, now can you hear me?
Yes.
Yes.
We can hear you now.
And then it went away again.
Yeah. If you're able to type your question into the chat box, we can definitely read it out loud. Hello?
Okay, sorry.
I can hear you.
You can? Okay, I just was saying
Yes.
that I have BlackRock funds and I never would think of them as ESG qualified. So it's interesting to me that Larry Fink was questioning Warren Buffett, because I never think of the BlackRock. I was thinking that the BlackRock funds were not so great ESG wise.
Yeah, you're absolutely right. And historically, they have been just like kind of agnostic about ESG focus. But as of last year, Larry Fink wrote in the big shareholder letter that this was going to be something that they are going to try and add as an overlay to all of their funds. They're going to add an ESG metric and a sustainability score to everything they invest in. So it is new, and frankly, it probably is marketing, but I don't care too much if it actually moves the needle.
Exactly. Thank you.
There's also a movement at the Texas legislature to prohibit state pensions from investing in companies and funds that prohibit investment in fossil fuels. So this is having a little bit of a backlash.
Mm-hmm. That's a really good point. Yeah, the SEC is coming out with something similar, that they were going to try and say that there were no, it was an ERISA rule, right, Sarah? That 401ks could not invest in ESG funds?
Yeah, I think that it was really difficult for a long time under ERISA to get funds in there. like explicitly as
Yeah.
funds.
Yeah, exactly. They were very explicit, at least in the last administration, that you could not hold companies or funds that called themselves ESG in a 401k. They claimed it was an expense ratio issue. I don't know why. I think probably it came back down to more something along the lines of, it's the Wild West, it's not standardized, we're not really sure. If you see the word ESG on there, you may think it's great and it may not be, because that is possible. But I think that it's a little bit strange that they're going to try and say that these 401ks can't even have it on their menu, when if you've ever looked at your 401k menu, there's a lot of weird stuff on there. So I don't know why. But I think that we're moving away from that. Again, as the assets flow into this category, you're just not going to be able to keep it down.
I don't want to interrupt you, Kacie, but I'm a lawyer and I have a little background in ERISA, and I think the idea, the general idea behind ERISA is to protect pension benefits, and I think maybe the possibility maybe that they thought ESG was not going to protect that. I mean, it was too speculative maybe.
That's definitely possible. And they're also, I mean, you always have to follow the dollars, like who makes these rules. And if the asset managers didn't have ESG funds, then maybe they also were perhaps lobbying in a certain direction. Okay. That's just speculation on my part.
Okay.
But
Interesting.
possible.
Very interesting. Thank you.
It would be unfortunate, but I think that type of thing does happen. Okay, so we're moving on to the most exciting part of ESG investing, or socially responsible, mission-driven, whatever you want to call it. Okay, you guys, this is the fun part. Why did Alexis Colby care about shareholder meetings? Why did anybody watch Old Dynasty? I tried to find pictures from the new Dynasty reboot on the CW, but frankly, there have been like 3 different Alexises, and I don't watch the show, so I didn't know which one to choose. But from the 80s, Alexis Colby cared about your shareholder meetings, and she would come swanning in wearing furs and saying, I own 50% of this company and I get to make the decisions, because that is what happens at an annual shareholders meeting. You get to vote. You get to make the decisions about executive compensation and the who's on the board of director and what kind of qualifications people have to vote, to be on the board. You ask questions directly of those directors. You vote on what the company is going to focus on in the coming year. And that's on an individual shareholder basis. As a fund, you can assign your votes through a proxy statement to the managers of your funds. And so that means that the people who are managing these giant mutual funds or giant exchange traded funds, they have the proxies of all of the people who didn't want to vote individually, and therefore they can hold these companies accountable and say, I think that you should focus on water pollution, or I think you should cut your carbon emissions by 2050, or whatever it is that they're worried about, right? Those mutual funds have a fiduciary duty to everyone who gave their proxy over to the fund to do what is in the best interest of the shareholder. And therefore, again, you might be able to speak to this more from a legal perspective, Jeannie, but it's in our fiduciary duty. It's what's written in this prospectus that you're going to be an ESG fund. So holding these companies accountable for what they say they're going to do, I think that falls on the actual funds who are voting for us to do so at the shareholder meetings. Do you have any perspective, Jeannie? What do you think about that?
Well, I'm in this lawyer group, and we just, a year or so ago, we did a presentation on climate change. And I think climate change has been around for a while, but the consensus is picking up that it's a real threat to the bottom line of everyone. So I think that changes the conversation. And so I think the Warren Buffetts are going to be pressured to get on board with the Greta, what's her last name?
Thunberg?
Climate activist.
Thunberg.
Yes. Yeah. I mean, you know, it's just a factor. And so ERISA, fiduciary duty, and then exactly the fund managers. So it's really changing. It's not just about, I mean, the climate change seems to be a real threat from what I,
absolutely.
unless you listen to Fox News or Trump or, you know, former President Trump. I mean, it just depends on who you talk to, but it's just, and you live in Texas and it's just really, really warm. It's just going to make, from what I've read, it's just going to make things more expensive.
Exactly. And so it is in our fiduciary duty for these companies to vote for what's best for us. And if they can say it is in the best interest, then we're going to vote our proxy to impact climate change or impact whatever it is that they said that they were going to care about when they set out their prospectus, the document that outlines what a fund is going to do. And then they have these millions of votes behind them. That, I think, is what creates shareholder advocacy. That's what makes a difference. To me, this kind of impact investing is what makes it worth paying a little bit extra to a company that is going to do something a little bit more than just matching the index, because they are going to have more of that due diligence on the individual proposals that are going to come up at an annual shareholders meeting. So a couple examples we have here come from Green Century Funds and Community Capital Management. I've got two examples. One's an equity fund, one's primarily a bond fund. The Green Century, and both of these I pulled this morning from their company websites. And so it's not like I found these or crafted these. These are examples that they are putting out there. Green Century Fund is trying to reduce the unsustainable production of palm oil. Has everybody seen those pictures of adorable little baby orangutans and what happens as the forests are cleared for palm oil production? It makes you never want to eat peanut butter. It's awful. And so they are trying to reduce that. The Community Capital Management Fund, it's a bond fund that primarily focuses on, oh gosh, what's the word for it? Well, it's a bond fund that invests in government bonds that are supposed to do good things for the communities that they invest in. So for an example here, we have an apartment complex that they are building and revitalizing that helps provide affordable housing and creates a sense of community in this neighborhood and helps these families stay close to their schools, all of these different things. Affordable housing is the word that my brain couldn't come up with a minute ago. And so these are just examples from these two different mutual funds of the ways that they are using their shareholder advocacy to try and create change through proxy statements or through voting or where they're putting their dollars to work. So these are just a couple of examples. There's a million of these things out there. Like I said, there's 826 funds, so there's plenty of places. So to me, it can be a little overwhelming, like how to choose the funds. What are you looking for? I'd like to open it up once we're done here to talk a little bit more about what you guys find the most urgent when we're looking at like the ESG factors. What do you focus on? The research I was reading said that the answer they get the most is the social element, like labor practices and just being good citizens towards our neighbors. But I would be really interested to see what everybody thinks.
Hey, Kacie.
And then the last
sorry,
couple.
maybe you're about to get to this, Kacie, but I was going to ask if you could go back a little bit to a couple of the terms that you've been using. I think the main one I'm thinking about is prospectus, right? Maybe you could tell the people on the call what a prospectus is and where to find it and what you can find in the prospectus. Because I think that, as we're talking about finding funds that match your values, it seems like there's going to be good info in there. So could you spend a minute just getting people up to speed on that?
Yeah, absolutely. And Sarah's absolutely right. So every fund that you invest in has a prospectus. It's not special to the ESG world. It is the guiding document of what a fund can or cannot do. And it's supposed to outline what they are investing in, how much they can charge, who they can trade with, all of these different rules. And you can find it on the website of wherever you're investing. So if you're a Vanguard investor, it'll be on the Vanguard website, BlackRock, etc., Fidelity funds, etc. And you can download those prospectuses. They update them once a year. And you can see what they're charging, like the internal expense ratios. If you guys remember from your investing 101, that is the baked in price of a particular mutual fund or exchange traded fund. It's not going to be reflected in the daily trading price, but it's how much of your investment goes back to the house to either keep the lights on or to provide marketing materials or to do the due diligence. And so a lot of the more active advocacy funds, their price is going to be just a little bit higher. When I was researching just this morning on Fidelity, like their whole sustainable list, the internal expense ratios ranged from 0.1%. And then there was one fund, it must be brand new because it was 2.26. Don't invest in something that's going to take 2.26% of your money. But that's just the scale. And so in that prospectus, back to the whole point, the expense ratio is defined, how much they pay for marketing and all of those kind of things are defined. And then also what the company can, or what the fund can invest in. And it's generally written as, we will primarily invest the bulk of our dollars towards XYZ kind of things. And then if there are exclusions like nuclear weapons and GMOs and all of those things, that will also be defined in the prospectus. So you can find all of that information there. And I think it really helps because the funds can be named whatever they want, but the prospectus actually shows you what they can and cannot do. Okay, so it could be called like the Brighter Day Good for You Fund, but then when you investigate, it could just be absolute trash. What do you guys think?
Awesome, thank you.
Sure.
I have another question, but I'll wait till the Q&A session.
Okay. Some resources that I like, and again, these are the most broad. The Green Money Journal is such a great resource because it is some super hippy dippy stuff where they are really showcasing all of these different types of socially responsible funds. And going back to that first element, socially responsible is kind of the older term for this. It's an umbrella. And in my opinion, I like to view it as that's the umbrella and ESG is the measurement. So right now it's trendy to call all of these funds ESG funds, but socially responsible kind of encompasses them a little more thoroughly. The second point is Morningstar, which is a really well-known research aggregator, has specifically an ESG investing, if I can get my little, there we go, has a specific ESG investing webpage. So you can see more about their sustainability metrics, what they're measuring, and you can find the different funds that fit those parameters. The second resource that I would point you towards is wherever you do your investing, they probably have screeners for this by now. So just, again, some simple Googling on my part. These kind of screeners are available on the Vanguard, Fidelity, and Schwab websites. They all have criteria or categories called sustainable or ESG, and use what you already know about fund selection to look for good choices in the first place inside those criteria. So you're going to be looking for how long has this fund been around? What's the inception date? You want to look at what's the manager turnover? Did they recently relabel themselves? That might be a really good indication of greenwashing. If it used to be called the Better Funds Deep Value Fund, and suddenly now it's called the Better Funds ESG Fund, what actually changed? Maybe nothing. Maybe they're just taking advantage of the marketing. So you apply all of your own criteria to your screeners. Okay, then the last thing is that, again, I know this is super corny, but every change we make, I think, makes a difference a little bit. So maybe you move to just the index. Like instead of using the S&P 500, now you use the KLD 400 as your primary benchmark. You're probably going to get outperformance, and it makes a little bit of a difference. If there's a particular criteria that's really important to you and you start searching for funds that meet those criteria, there is a whole world of investments that we didn't get into that are trying to say they are for the betterment of women. That one I find a little bit iffy, but you know, it's moving in the right direction. So it will make a difference eventually. And that is the end of my prepared remarks. Let's get into the question portion.
All right, so we have it set up so that now if you have a question that you'd like to ask to the group or to Kacie, you can unmute yourself without having to ask the host. So if you'll have questions, please feel free to unmute yourselves or stick them in the chat. If you stick them in the chat, then we'll read them out loud for everybody to hear.
Yeah, and also if you just want to chime in on which of these criteria you find important, I would love to hear it. All right, Jeannie, did you want to have?
Well, what popped into my mind was, you know, you're supposed to balance your portfolio, and how does this factor into it, the green type of investing?
What a great question. So as you are
like nuclear power to balance it out, or?
Well, when I think of balancing, I think of weightings by asset category, like large cap, small cap, foreign, domestic.
Okay.
Stocks versus bonds. That's generally what I think of when I think of rebalancing. And you can do this kind of ESG overlay in all of those different asset classes. Okay. So you can seek out funds that are mid cap and maybe emerging markets or whatever. You can still have all of those different style boxes covered and have the ESG criteria.
So what you're saying is that the ESG transcends all of the asset classes?
I think so.
Okay.
I mean, as you can imagine, intuitively, it's always going to be a little bit harder to find ESG appropriate or companies that meet ESG standards if you're investing in things like true emerging markets. That may not be as available, or it might be harder to do the due diligence on. So if you can find them, it might be super expensive.
Well, what's an example of an emerging market?
Emerging market funds are funds that are focused on investing your dollars in the developing world. So it's countries like Brazil, Russia, India, China. It is, I think South Africa still counts as developing. A lot of your more Asian smaller countries, those all still count as they're in the developing. But you know what's weird is sometimes it includes Mexico. So, you know, who knows?
Okay,
Does anybody else have thoughts?
We have a comment and a question from Julia. Julia says, in the beginning of the presentation, I thought it was really interesting that you mentioned South African apartheid. What came to mind for me was the BDS movement, boycott, divestment, and sanctions, a Palestinian-led movement that promotes an economic boycott of companies participating in Israel's oppression of Palestinians. Is the BDS movement included in ESG scores? And if not, do you see it as becoming included in the near future as Palestinian liberation becomes an issue that's more mainstream for Americans?
Yeah, that's a really interesting point, because I feel like I was completely ignorant of how important that was until the most recent uprisings. And so I don't know for sure. I really don't. And I assume that the MSCI scores are including in that controversy element. I assume that they are including any type of military action, I guess is the right way to put it. And so, yeah, I would assume that that's included, but I don't know for sure. The really neat thing about the KLD 400 is that you can look at those different score criterias to see exactly what they're using. So if you go to the MSCI website, you can look up the controversies element and see what they're rating those companies on. And the same thing for business involvement and risks and opportunities, those three different criteria that MSCI was using. So that's really interesting. And I think that it's one of those things that we can continue to advocate for if there are companies that should or should not be included, or should change their practices if they're going to be included.
Yeah, Kacie, I wonder if I can piggyback on what you said a little bit, kind of on this question. One thing that I found, like, in the industry that I think is really exciting is that new people are starting new funds all the time. And I think it used to be that it was kind of expensive to start a mutual fund or an exchange traded fund. So you needed a lot of assets under management to make that happen. But I think that's changing. So any fund manager or any professional person who wants to start a fund based on literally any set of criteria can go out and start that fund. I mean, and it can be really, really, it can be very narrow and specific. It can be, you know, broader and less specific. But I think, like, over the last, 12 or 24 months, I think Kacie and I have probably both seen new fund offerings that think about the universe of investments in really different ways. And so if someone wanted to start a fund, you know, based on the criteria in your question, Julia, they could, right? And, you know, maybe you would need $10 million of, you know, worth of people putting a bunch of people putting $10 million in to start a fund that meets these criteria. But it could happen if it hasn't already. You don't necessarily need a big fund to buy into this, you know, in order to make it happen. You can have a person or a small firm do it.
Yeah, and even if there are already funds that focus on conflict-free companies that then made this a major priority, that could happen too. And so it's one of those things that if you just kind of do the research, you may already find that this is something that's out there. And yes, it is becoming more and more widely known by the regular investor. And so I can absolutely see it becoming a bigger point in the investment world, because we're already screening out a lot of different military elements. And so why not this one?
Thank you. That was really helpful. I appreciate everything that you shared and gives me a lot more to think about.
Great.
I have more questions. Unless
Go
someone
for it.
else does. This is for Kacie and Sarah. First of all, I just wanted to say to Sarah, I really appreciate you starting this group. I didn't join until maybe 2 or 3 years ago, and I've just become very fascinated by the stock market because, you know, for the Tesla example, when I gave that presentation, when I was working on the climate change presentation, I showed a photo of the Tesla car charging at one of Austin's on Electric Avenue. And then that stock just surged. And when you talked about Tesla being not that high on the ESG compared to Chevron, I think a lot of the momentum is behind just people think it's cool, and it's not always based on reason. The stock market has this psychological component. But so my question is, how, if you don't have an MBA like Sarah, or you don't have the certifications that you do, Kacie, how do you, in an organized manner, learn about investment things? And how do you, I have the Wall Street Journal, but I mean, the truth is, I migrate to the life section in the magazine part of it, and I don't like dive into the really. I did read that article before this this afternoon about the Dominion company and the.
Yeah, that's what I read too.
And I thought, I want to buy that stock because they have these huge wind farms in the middle of the ocean. And you kind of wonder, how do they do that? It's like Tesla. It's so cool. And I thought, should I buy this stock? But I don't, you know, it's really hard to learn about investing when you don't have that type of background, when you have a philosophy background. And the law isn't really, unless you practice law that's related to investments, it's not necessarily point on. So if you have any guidance for us to go beyond just taking this class, to taking this the Zoom call once a month for the investors that aren't as well trained as you all ladies.
Sarah, do you want to take this one?
And I want to take Sarah's class. I do know she teaches a class that I want to take.
Yeah. So I would say, like, for people who are beginning, so as not to get overwhelmed, I think the first step is, once you've gotten past the point and you're like, okay, I'm going to invest in, let's just say the stock market, I'm going to invest in the stock market. I think the first step is to diversify. That adds in a layer of protection where you are not required to know everything. And you get that through diversification. So that means instead of focusing on individual companies, you focus on funds, exchange traded funds, or mutual funds. And I think that's where you start. There's no expectation that people, even professionals, there's no expectation you put together a perfect portfolio. You can start with something and then change your mind later as you learn more. And so I think that for people, like, if we kind of start with this idea of funds, whether they're ESG funds or not, right? One of the things that you can do, so Kacie mentioned in her slides Morningstar as a resource. Maybe I'll share my screen here. Can I share my screen, maybe? So I went here to Morningstar. Can you guys see my screen?
Yes.
Okay. So I went to Morningstar, the site, and I just started. Kacie also mentioned a fund company called Parnassus, which is very well known in the ESG sphere. And I started typing in the word Parnassus in the quote box, and I got to this Parnassus Core Equity International Fund, or Institutional Fund. I think especially with, if you want to screen out companies, there are companies you don't want to own. I think one of the questions is, well, how do I know if the fund owns them? Like these companies, right? You can go to a place like Morningstar. You can look at, see this portfolio tab here? You click on portfolio. And if you scroll down, there's all this information. You can read it if you want to. Oh, nuts. It went away. Come back. All right, I'm just going to talk slower while I'm waiting for the page to reload. And I'm scrolling down on the page past kind of all this stuff, which you can kind of skip over. And you can get to a place where you can see the holdings, right? So for this fund, Julia kind of asked a question along these lines, like, what if I just really want to make sure I'm not investing in a company that I'm loath to invest in, right? You find a handful of funds and then you start doing the research, like Kacie mentioned. You can find what are the actual companies in the fund. So this one is kind of easy because this fund only has 39 companies that it owns. You can kind of see it all on one page. But now you can look through the whole list of companies here and you can see like, okay, like, does this meet my criteria? Or do I see like a big like red flag company, especially if the big red flag company is at the top of the weighting? You can see here, Microsoft makes up almost 6% of this portfolio. If Microsoft was one of your red flag companies and you're like, nope, like for whatever reason, I do not want to own Microsoft. Now this one gets, this fund gets chucked out because it owns Microsoft. Right? Amazon is on your list. Like this, miraculously is a mutual fund that does not own.
Yeah.
Like, I don't know, right?
And Amazon came up for that very reason, because that's the one company that I've had a lot of people in the last year say, I don't want to hold Amazon. And it's a big part of the index. So you have to do this kind of deeper dive that Sarah's showing you to get away from some of those really big players.
Yeah. I mean, and one of the other things that Kacie and I do, I think as part of our due diligence for clients is you read the prospectus, like Kacie said. So we would go to Parnassus, download the prospectus, see what the fund company is telling you. And then I think like you sign up for the webinars that the mutual fund does every quarter. I don't know, I have like a handful of funds where I know the people that manage the portfolio do a webinar every quarter. They send me an email that it's about to happen. And so every quarter I can listen to the reasons that the portfolio managers are giving for including or excluding companies from the fund. And for ESG companies, that's really important. I mean, I've heard, portfolio managers that are trying to decide what companies go in their funds, they'll have the same discussion about Amazon. The reason we exclude Amazon is like that labor union thing was not cool, right? And so we have decided to exclude them. If Amazon changes their practices in regards to labor unions, maybe it'll get included down the road if they've made progress, on those ESG criteria. So I don't know if Jeannie, that kind of answers your question, but I feel
it does.
Like if there's like the information exists for non-professionals to find, I think, some of the pieces of information that are very meaningful to them. And this list of holdings to me is very meaningful. Like you can come to it, you can be like, okay, I get a general idea of what this fund is going for. And if I need more detail, I'll go down that route. So that I think that's broad and ended up very specific for my advice, but I'm just going to leave that out there because I think especially in this case where you're trying to do the best you can with your dollars, the information, it is possible to find the information that will give you peace of mind.
Okay, and here's one more.
And you're absolutely right. Oh.
So we're trying, the whole goal of this is to, I mean, I would love to store all my cash in a bank account like a little squirrel storing nuts, but that's not safe because of inflation. So that's the one thing, that's the one recurring theme I'm getting from the learning I'm doing. But you had mentioned an index fund called VTC. So, and that's a total stock market. But
VTI.
And there isn't that the total?
Yeah, VTI.
Okay, VTI. There's another one called VOO, which is the S&P 500. And one of the videos I was watching on YouTube, the random videos, I think by Charlie Chang, said something about, well, VOO is good because it's these large companies that really move the market, like Amazon, even though people don't always like Amazon. So is it just more, how do you decide to choose VTI over VOO or things like that?
You want to take that, Kacie?
Actually,
I think that when you are first,
I kind of want to break in and say, Jeannie, you're so right. It is really hard. And this almost sounds like a topic for like a whole meeting where maybe we go to Morningstar and we compare some, because I was just looking at this recently too. You know, I want to make sure I'm in the market. And so I was trying to find a fund to kind of put my money while I was trying to figure out what to do with it, so it wouldn't just be sitting in cash. And it's hard to decide. And also some of the decisions might end up being very personal. Like if you have an advisor, they might have like experience with the fund, so they might suggest one or the other. But if you're starting out, you kind of just pick one and you just have to see what happens. But Sarah, I think this might be like a great topic for us to talk about in general.
Yeah.
But I think there were some other people who had some other questions about sustainability stuff. And so I want to make sure we get to those before we go if we have time to go back and talk more about this. Is that okay, Jeannie?
Yes, thank you so much for your answer.
but I think that on the topic of both of those things regarding, you know, the individual fund choices in a very similar asset class and just the ESG research, both of those, I point you towards the websites for whichever company you're looking at in the first place, be that Parnassus or Vanguard or whoever it is, because there is so much information available there. Like Sarah said, there's the quarterly webinars, and if you don't have time to listen to the whole webinar, they often will put out transcripts, or they'll also have quarterly commentaries. So you can read or you can listen, whichever is better for you as a learner. And they have little fact sheets that's just like a summary page that shows you what are the top 10 holdings, which part of the style box are they most invested in, how much assets are under management and what are they charging. Like it's a short little summary, and those are updated each quarter. And so I think that all of those different pieces of due diligence are very useful. And as you do it more and more, you'll find which ones are a go-to for you specifically. So things like with that Parnassus example, I mean, the individual stories to me are so powerful, and I can get really caught up in them. But I've been caught up in those individual stories since I first started investing. Like funds that were investing in emerging world, like emerging markets or developing world debt, were really interesting to me because of the individual stories about how much it changed the community when dollars were invested there, you know, just as an interesting sociological kind of a thing. Well, now if that story is about how community capital management helped build a neighborhood in Atlanta that actually had sidewalks, and it led to more people engaging with their community, it was just like, I wish my neighborhood had sidewalks. Like, that's really cool. You know, these things that I just find so absolutely interesting and bring that human element into the investing. Because if you're going to put your dollars somewhere, then why not know more about it and like know it the same way we know a TV show or something like that? Like, there are human stories behind all of these different investments. And I think that it's the most interesting part of it. It like makes it the most real to me.
So speaking of Morningstar, there was a question that came in, and I love how I think about like how ESGs and SRIs kind of lead you to this like series of questions about, you start to like interrogate, you know, like, well, what about this and what about that? So there's this question from Betsy: is there any concern about the integrity of Morningstar or other ESG rating companies being compromised? Similar to the way that auditors like Ernst & Young have failed to properly audit big financial institutions in the past.
Oh, I'm sure. You always have to be concerned, right? I do think that having multiple sources for those types of ratings is useful. So, you know, always do your due diligence from multiple sources. But Sarah, do you have any further input to that?
I mean, I would say like on my list of concerns, I would go with like, sure, like I'm concerned, but I'm concerned about a lot of other things a lot more. So if I'm prioritizing my concerns, like my priority would be, okay, like I know there are companies I want to exclude from my investments. And then I mean, Morningstar is like, as of now, Morningstar is a great company. I rely on their information. I think like certainly like you always have to cross-check and, you know, make sure you're not letting anyone who steps into that void of starting to rank things and rate things and become the go-to place in the industry. Like certainly you would think conflicts could arise. So I would like keep an eye on it, but I wouldn't let that move forward. Because Morningstar, the great thing about Morningstar, it's really easy to use and there's a ton of information on there and a lot of it is free. So I think that it's okay to be concerned, but I wouldn't dig too far into that concern if other concerns are more important with Morningstar.
Yeah, that's a good point. And you can cross-reference so many of these different things. So if Morningstar is your starting point, then it can lead you down different rabbit trails and you can get into like the archives of the Green Money Journal.
Yeah.
I mean, hopefully you have better things to do on your weekend, but I've done it. And I'm just like, oh yeah, oh, this is so interesting. Oh, 4 hours has passed. I should feed my children. You know, whatever happens.
Is the idea behind Morningstar that it's objective? I mean, compared to the information on your brokerage's website?
I mean, I kind of throw most of that information all in the category of websites that scrape information from the SEC, right? So like a lot of these places just go to the filings from the sec.gov and pull that information in and put it in a more user-friendly for you to use. Morningstar has their ranking system, like their 5-star and their bronze, gold, silver ranking systems. But a lot of the information they're getting is coming from another source, right? They're just aggregating a lot of that information for you. So I think that, and if you look at like Schwab, I would be super surprised if Schwab wasn't powered by Morningstar. Or
it probably is.
Research wasn't powered by Morningstar. So
okay,
it's all
okay.
the same place.
Yeah, that's a good point.
We have those grades. Schwab has grades for stocks, but the 2 stocks, I think they're called momentum stocks that I bought, I've made the most money on them. And they started out not rated, low grades. Because, you know, you buy early and then the stock increases. So I find the grades, those types of letter grades, not to be always, I guess,
you
indicative of
do take
financial.
those with a grain of salt. I agree.
Okay.
Yeah. like, again, like with the way I use Morningstar is for some of the details here, not relying on the funds they give 5 stars to or 1 star to.
Bronze or gold or whatever.
Right.
Yeah.
Right.
Yeah.
Like they do an okay job with that stuff, but really like they're like, as far as like their data, like aggregation that they, they bring in from the SEC and its user friendliness, that's mainly what I use Morningstar for.
Yeah, that's a good point, because there is like an objective and a subjective element. And so that more subjective element, I used to work at a mutual fund company, and I know that they do give feedback to Morningstar that says, like, I don't think you should have ranked us XYZ because of these reasons. And it's very possible that Morningstar would potentially change their decisions on those things.
Yeah, the rankings are where the conflicts are, for sure.
Mm-hmm. But the objective things, like Sarah saying, like how many dollars under management and what they're holding, that stuff, that's just info. So,
I had Kacie, this is Caitlin. I had another question for you. It's a little abstract because I don't invest in individual companies, but just sort of taking that macro view that you were presenting of the influence of the market. I'm thinking about a company like Walmart that I believe, without doing any of my own independent research, that I would not support for many different reasons, living wage, whatever. However, so I would be looking and be like, I want to make sure that I'm not investing in Walmart. My unresearched whatever take is I don't. But then they do something, and this goes back to scale, like change all their light bulbs in all of their stores. And that one thing has a bigger impact on carbon emissions for the entire country than me driving a hybrid, which I don't have. And so I'm just curious about like this idea of shunning some companies, like then how we reward them for doing good things. I guess then they get in an ESG rate, they do enough of them and their rating will get higher. So by voting with our dollars towards the ESG, I'm thinking aloud here, by voting with our dollars, they see there's a financial incentive to do those things. So I don't have to respond to each major corporation with my money to say, yep, good job, do more. That'll happen naturally by them wanting that ranking or to meet that criteria.
You're absolutely right. And you can add on another layer, because like I said, there's kind of the different scope of these ESG funds. So if you are investing in an index focused, low cost investment that has ESG overlay, it may or may not hold Walmart because Walmart has, this environmental component. Well, if the social element is what you're really concerned about, you may go out there and seek a fund that is truly focused on the social impact. And maybe by putting your dollars towards that, the managers of that particular fund are going to seek out companies who have a higher score in that social element, and also advocate to companies like Walmart, you guys got to increase your base pay, or you've got to allow people to have longer breaks, or whatever elements that you are trying to encourage them to do by pointing your input to your fund manager. And then the fund manager takes your input and everybody else's and puts big money behind it. Because yeah, my $100 does what, I don't know what it does, nothing. But if I've got, the power of like Impacts or Sally Krawcheck at Elvest, somebody like that can put some big money behind things, that's when you're going to see major, major change.
Oh, I love this, Kacie, because I feel like for so many women, and a lot of women I know, avoiding the stock market is sort of like, it's a good cover, like when you're doing it because you're scared to think about or talk about money. You also have a good cover because you don't believe in the capitalist system, because they're all bastard corporations that are in it. And in this way, it's actually,
they are, for sure,
of course, but you can influence it by not being in it. You let them, that you have no say in what they're going to do, but by being in it, it's another form of advocacy for where your money's going to be and how that can shape what those corporations are doing. So I
investment focused if climate change is what you're caring about. There are water focused funds. I mean, like Sarah was saying earlier, there's a fund for anything. And I want to send you back to those screeners on your investment platform of choice, Fidelity, Schwab, whoever it might be, and search for the things that you care about. So like I bought a fund recently that was focused on clean water. And yeah, it's gonna hopefully make me some money because it's a good thing to have new ways to process water, and maybe like desalinization is gonna actually make money someday. I don't know, but also it makes me feel less scummy to invest in things that I wanna see happen.
So some people were asking on the thread on our chat box, as well as in Facebook, there's a lot of people interested in environmentally focused funds. And so I guess I'd ask you, and also anybody in the meeting, if they have any suggestions for funds that are focused on the environment or the climate or something like that. Somebody in the chat box, Nicole, put NIA Impact. And she also mentioned that they have women-focused funds. So that's a good one to go look at. Does anybody else have any other suggestions?
The only thing about the women focus just reminds me of a story. So about 6 months ago, I had a fund company that was, I'll protect the non-innocent, but essentially they were really harping on me that we should be buying their women-focused fund and how much they were doing for gender inclusivity. And I pulled up the fact sheet, and it's run by 4 white men, as you might imagine. So that kind of thing is something to look for. So as you're researching these different companies, and once again, I point you back to the websites. There is a lot of money to be made with just putting this mantle on yourself and saying, we're trying to do right for the world. But then when you look under the hood, it may not be what you're really looking for. So I am always open to new funds that people think are making money and also doing what they say they're going to do.
Yeah, and to on a lot of these ideas that like maybe you see research or you see a story about a company that was founded to solve this environmental problem, right? Like I can't even think what, like you read a story about a person who invented a robot to pluck all of the plastic bags out of the ocean, right? And you're like, oh, I totally want to invest in that. That is something I want to support. Remember that there are many companies and ideas you can't invest in because they're privately held companies, or they're prototypes or technologies that haven't gone to market yet. So the companies haven't actually figured out how to sell this technology to someone. So I think that's part of, especially people who are, are really focused on like companies that are solving environmental problems. A lot of those really cool ideas that you wish you could invest in are not actually in the market, right? The company, either the market or the company isn't publicly traded, or the technology is not actually sold to anyone at this point in time. There is no, there's no revenue being generated from that idea. So if, especially on the environmental side, if you're kind of starting to follow technologies that people are developing, then the people developing those technologies have to show who's going to buy this technology to solve this problem. And then who's going to take that company public, at which point then we here can invest in it. There might be some opportunities to do some angel investing at the very speculative, but on some of these like developing technologies. But I think especially in this space, and really like with investors like at large, you do have to remember you can't always invest in the thing you want to invest in. There might not be any opportunities there yet.
Mm-hmm. Guys, another thing I just saw in the chart was back to performance. Or I'm sorry, not the chart, the chat. I'm looking at the chart. Back to performance. This KLD performance compared to the MSCI standard US, this is very recent. This is as of April. And I ran the same research on just Yahoo Finance across the last 5 years, across the period from 2008 through 2012, and from 2006 to the present. And the social index beat it across all of those different timeframes. So I think that the performance is absolutely there. And part of that might be because it is a little bit more in the tech or large cap growth element of the, or, you know, sector of the market. But that's kind of the wave of the future.
I can ask another question.
Yeah.
Hey,
Great.
Kacie. When you read the Wall Street Journal, how do you read it? Just cover to cover, or do you look?
No, I'm going to stop you there, Jeannie. Do not read the Wall Street Journal from cover to cover.
It would take all day, I know.
Read the second section, the business, or what is it called? Markets and investing.
Markets and investing. Plus, I'm so lazy. I only get it online these days.
Yeah.
So I just have markets set as my default landing page.
Okay.
And then I also sometimes read way too many of the opinion pieces because old men get so grumpy. It's so funny.
Section 2, Jeannie, do you get it in paper form? Do you get it delivered?
I get it electronically because I would like to get the paper version, but you know, the paper version builds up, and I live in an apartment, and so getting it delivered to my doorstep's not, and also you go out of town and you have to get, you know, so I think electronic it's not quite as nice. I love the paper version, but I do get electronically. But the benefit, if you get the paper version, then you get the electronic version. But the benefit of the electronic version is they have videos and interactive things.
Yeah.
Mm-hmm.
It's so nice to get the Wall Street Journal. It's just so nice.
Yeah.
And
Do they have a weekend only version, Sarah? Because I love their crossword.
I don't know if they have a weekend only version, but
I think that's a good reason to get the Wall Street Journal for their crossword. Probably not. It's like $100 a year.
A good reason to get the electronic version is because initially I was reading the weekend version, which comes out with a glossy magazine once a month, which is really nice, mostly ads, but $20 total, but the electronic version is $20, $22 or something like that, and has all things, but it has videos too. But okay, so Warren Buffett supposedly reads all day long. What is it he's reading? Does he, I mean,
he clearly doesn't have other things to do. I mean, I don't think you can read all day long. I'm sure he's reading all of these shareholder documents, and he's probably reading Barron's and Forbes and Wall Street Journal. I mean, has anybody else ever had to present a giant slideshow and therefore you procrastinate for way too many hours on the internet reading things that you shouldn't probably have been wasting your time on? Yeah. I certainly have yesterday. So I can see how you can fill a whole day with just farting around, like jumping from site to site, reading, oh, I didn't read this one yet. So I'm sure that's what he does if he truly does read all day. But it would drive you insane. It would drive you insane.
He's probably reading the corporate documents with the, you know, of the companies that he owns or the companies that he wants to acquire. But
Okay.
you shouldn't do that. Like but I do like, again, section 2 of the Wall Street Journal, and then Kacie just mentioned Barron's. If you want to take it up to the next level,
Okay.
Barron's, like next level newspaper or publication that's really even more focused on just investing.
Okay.
The rest of the stuff is like corporate, like, do you want to read about like mergers and acquisitions? Like, no, just skip all that stuff. Skip all that corporate stuff and just go to the investing and market sections.
And I have another idea for Lori for a topic coming up. So I've never really sold any of my stocks, and some of them have fallen to zero, such as Horizon Dairy, which was one of those early ESG stocks. But, you know, people don't drink real milk anymore, so went bankrupt. But how do you start flagging a stock as one you might want to sell? You know, and you don't want to sell a stock at a loss, but sometimes you might have to avoid dropping to zero. Is that something that you might be able to talk about in an upcoming meeting?
Know when to sell. I like it.
Yeah, it's probably more an art than a science, but it's definitely something that we could talk about. Going along with that is, if you have some stocks that have a profit, do you want to sell some of your less performing stocks? How do you look at it from a tax perspective? I mean, that can get pretty complicated, but that might be why you want to sell something that's at a loss. Now, not just so you sell it before it goes down more, but if it's at a loss and you have something else that you're selling that you made a bunch of money and you're going to invest it in something else, then that might be why, because it evens out your gains, so your taxes aren't as much. So yeah, I'll put that on the list. That's a good suggestion. How do you get the stocks? Which ones do you pick? How do you get rid of them? Or I think they sometimes call that the exit strategy. What's your exit strategy?
Yeah, I like that.
Yeah, thanks, Jeannie. So there are some more questions, Kacie. One from Patricia earlier on was, do you have any more suggestions for how to tell if a fund is just greenwashing? Like,
again, yeah, that's a really good point. I think that there's a few things. Number one, who's putting it out? How recent is it? If it launched in the last year, it's very possible. What are the holdings? Like Sarah was showing us how to find the holdings. Are those holdings appropriate? Like if it says it's a water-focused fund, but then it's holding Microsoft, why? Let's look into that. And look at things like the manager change. If again on the fund's website or in their fact sheets, it'll show you who their managers are, and if those managers have changed recently, then that also might be a point towards it may just have been relaunched. And again, these are not necessarily deal breakers, but they are things to look for. You just want to make sure that you marry up the intention of the fund with what it's actually holding. Because like we say, it might be holding something like Shell and call itself an environmentally friendly fund. Well, it looks like Shell's actually trying to do some good stuff. And maybe it is just because it makes them money, but I mean, that's why we're all investing, is to make money. So, you know, that's not the worst.
Yeah, and to piggyback on the looking at the managers, I think also if you look at who the portfolio managers or the PMs, if you look at who the portfolio managers are and they don't have any experience in ESG investing until they got hired to run this fund.
Mm-hmm. Guys, I didn't even get into that.
Knowledge.
Yeah, but that is like a whole nother session. So like, first of all, female people make up like 20% of the financial world in general, but in ESG management or senior leadership, it's closer to 45%. So this has always been a very female focused category. And so that's another thing, that if you see a manager with no tenure and he went to an Ivy League school and he's a young white man, then maybe it's not a great fit, because there are more and more of them in like just pushing themselves into the space because it is a space that's making a lot of money. Not that they're necessarily doing anything wrong, but it's just like something to review.
And then I think maybe a good question to wrap up our meeting today. Jess asked 2 questions that I want to combine into one. Let me pull up the other one. Okay, so if you want your entire portfolio to be ecologically responsible, how would you suggest is the best way to achieve that? Are there any particular platforms you recommend? And is it possible to have a well-rounded account and only invest in a fund, in funds that focus on the environment or focus on whatever it is that someone prioritizes?
Unfortunately, at this time, I don't think it's possible to have a well-rounded, diversified portfolio that is all like doing the best. So that's kind of where like perfect is the enemy of good comes back in, or the whole little starfish picture that I think is so powerful. Like, you do what you can, and then you continue to advocate to these companies to do better. And by voting with our dollars, hopefully we will show them that there is more and more money to be made by being better.
Thank you. Kacie, thank you so much for coming and leading this topic. It was so awesome. And again, like, it was something that a lot of people had been asking about. So I'm so delighted that you could come and share your knowledge with everyone here. We are going to post it to our YouTube channel. So if people weren't able to make it, or if you want to go back and go through it again, it'll be up there in the next couple weeks. We'll send out an email to the meetup list. And then, you know, try to, if you can, like, try to join us in June for our next meeting here. You know, we try to cover topics that we think that everyone will be interested in, while like covering the basics as often as we can, because we believe in repetition and learning and, you know, coming back to the same concepts over and over again. So, you know, if this was your first time here, thank you for coming. If it was not your first time here, thank you for coming back. And certainly reach out to me or Gwen or Lori if you have any questions going forward. And thank you, Jeannie, for offering some topics for future, you know, what are we doing here? Meetings. And we'll try to get them on the calendar. So thank you, everyone. And we will see you in June.
Thank you.
Thank you, guys. Thank you so much for your time.